So what were you saying about the financing part?
What? Oh, just about the fact that rates are going high. Call now.
Oh my gosh, there's such a slight delay on the podcast, guys. So we do apologize. A lot of technical difficulties going on right now, and we have no clue what is going on.
Are we on right now?
Yeah, we're live.
Oh, we are.
Yeah.
Hi.
Is anybody there? Let us know.
Hi, everybody.
So it looks like there's 4 people that started logging in. And let us know if there's actually a delay, because it seems like there's such a lag and we don't know what is going on. Hopefully Jason is watching. Definitely help us out here.
Well, I can see it in the way you're talking.
Oh, can you really?
Yeah, look, see?
Is it moving fast?
Yeah, it's like one of those old movies.
Oh.
There it is.
So what, are we good? No, it's not. I mean, if you look on the audio testing, 1, 2, 3. Well, I mean, here's the thing. You can't watch it on here because on there might be coming out quick. But I mean, there's slight lag on my end, so that tells me that there is a lag on this end. You see what I'm saying?
I see what you're saying.
But well, Jason said there's no lag, that is strange. I wonder if he's making that up. Jason, are you serious? There's no lag?
Who's MVEL? They said good.
Are you sure, guys? We're good. Vanessa, thank you so much. So, look, guys, we only have a couple minutes now at this point because I screwed up and I do apologize. But, Dan, I want to get into, like, the financing and the loan programs because this is important. We talked about the LIFT a couple weeks ago. Can you explain to the audience what the LIFT program is and where are we at with that?
Well, there's no new news. The problem is they introduce these programs, then it takes such a long time to get passed.
Yeah.
But it was for first responders. But I just feel that now that like COVID's kind of settled itself in and people aren't really focused on it as much.
Yeah.
Is this really going to be a program that they're going to pass now?
So it's not even a real program.
Well, they introduced it as a real program, but it didn't get passed through legislation. And this is what happens a lot to these programs. They get introduced. Great idea, and then they just don't get any further than that. I don't know if it's a way for them to, hey guys, look what we're trying to do to help you.
Yeah.
And it's more of a maybe a politician putting themselves out there, or somebody putting that out there to promote themselves more so than are you actually really going to pass that program. Now there is housing affordability going on that Nevada's putting out, and it's going to be for a lot of low-income families. That's still going to happen here.
Yeah.
And that's going to be a big deal. Again, though, where is it going to be, right? And so they said it's going to be up towards like Cactus, I think, between Rainbow and Buffalo.
I seen that, but I didn't read the article, and I think you got to make less than, what, $68,000 or something?
Yeah,
is that correct?
It's correct. And, I don't know, like, there's got to be a perfect blend. But when you look at, and this is not a stereotype, but
yeah,
it's got to be in an area, like just certain areas want those types of housings because it's going to lower their housing, right? It's going to lower their area typically because now you're getting people that are coming in buying, half the cost of what it would probably be to buy a home or a lot less. So now it's going to drive that market down. Plus, what if you can't do it next to like $1 million homes?
I don't know if they're going to build homes like that. I think what it is it the homes that they're building that's a lower price?
It's homes.
It's actually homes.
It's actually homes. Yeah. So again, this is very preliminary stages, but even if let's say it's dwellings that are shared, right? You got housing that's shared. Is it going to have an impact on people that are for the lower income families? Sure. Now, who's going to qualify? We don't know. It could be something like, hey, you know what? You got a family of 3 and you make this and, you need the housing. Maybe they're going to give it to you. I'm not sure. But I guess the thing is the location. And then you see, there's a lot of apartment complexes around Vegas, right?
Yeah.
I feel that needs to be delegated to a certain point. Now, there's a lot of high-end apartment complexes, but do you feel like apartment complexes bring down the values of homes?
Not necessarily, depending on the location. But I want to go back to programs because this is important because this is really about financing today.
Right.
What programs do you guys currently have right now with your company?
Well, with our company, it's the same as everybody. You you have the home is possible, the home at last. And, we had somebody talk about that before, and, there's a certain income level that you get, but then some of the rates and stuff, like if it's a teacher's program, they have that. So if you're a teacher out there, you can benefit from a teacher's program, and they give you a really good interest rate on that. So it's traditionally the same stuff. The problem with a lot of these things is that people are trying to get some type of housing assistance.
Yeah.
And the assistance is introduced, and then it just doesn't seem like, it's kind of like stagnated. It doesn't move forward. It just seems like a lot of this stuff comes out, and then it's like, well, when is this going to come out? Or if it does come out, it's for a very short window of time. There was at one point the city there was money left over. I forget what the whole program was about, but they had I think it was like $20 million. And what it would do is you would get, it was like an overage. I forget the name of it, but it was going on a couple of years ago. But they had $20 million, and they said, okay, it's a first come, first served basis. You have to reserve the money, and after it goes away, we don't have it anymore.
Yeah.
And it was only for like 3 or 4 months.
Well, no, the problem was the money got eaten up pretty quickly.
Yeah,
that's because, what happened.
Well, you think $20 million is a lot, but then when you have this amount of people moving to Vegas,
yeah,
they thought it was going to go away in like 6 months. It actually went away in like less than that, like half. So these programs and things, I don't necessarily see that a lot of these programs we used to see in the past.
Yeah.
Post-COVID.
What's crazy is it definitely helps you as far as for you to get finance for a home, but some of these programs, they do have certain restrictions.
Every one of them.
Yeah, it seems like you could limit yourself, and also typically in today's market, the way that the market is,
yeah,
when you have these type of programs, sometimes sellers will not accept your offer.
Well, that's another thing too, is it's what is the real shot that you got to get an offer accepted? If I got a seller selling a house,
yeah,
and I'm not trying to be biased. I mean, I'm going to go for the best offer, and you're going to present it. But would you rather go with somebody that has 20% down, offering the same thing, versus somebody that's coming in with down payment assistance but offering the same thing? You're always going to go with somebody that's got a little bit more assets, because traditionally, less problems going into underwriting, less problems going into financing. So I get it.
And not only that, it's when you have these type of programs, you're barely scraping by to get the deal done.
Yeah.
And I think that's the reason why sellers are kind of hesitant with that. However, it doesn't mean that you can't still get into escrow. It just means that you got to have your ducks in a line, right? Because there's times where we deal with buyers that do FHA, but I think the last FHA loan deal I did was probably about maybe like a year and a half ago.
Yeah. I mean, look, it's not to say that we don't help, but let's be honest with the situation.
Yeah.
You're not going to get any closing costs paid by the seller.
Mm-hmm.
If you need to come out of list price, you're not going to get that.
Unless you have the money.
Well, the down payment assistance typically doesn't. And they're not going to reward you by saying, well, I got $100,000 in the bank, and I want down payment. Now, it's not saying they're going to decline you, but traditionally that's a loan for people that need it. Mm-hmm. And so, I don't know. To me, looking at the situation, I haven't done down payment assistance in a while. The housing is being offered, the opportunities. It's a grant. There's, like I said, the affordability plan that's going on right now in Las Vegas that they're prepping and planning for. It's interesting to see, like, is this going to be something where, what is the qualifications? Is it going to be your credit score has got to be this, and your income's got to be this, and it's going to be so restrictive that it's going to be like 10% of the population approved for it.
Now, let's talk about FHA real quick. What does FHA stand for, and what's the benefits to having an FHA loan?
FHA it's the Federal Housing Association, but it's really for it's insured by the government.
Yep.
And so you look at their position on this, and they're the ones that typically are a little bit less restrictive, right? When it comes to certain things.
Give me an example when you say that.
Let's say that your credit score is lower.
Okay.
Let's say you don't have reserves. Let's say you don't have money in the bank.
Okay.
Right? Let's say that your debt ratio may be slightly higher.
Mm-hmm.
That might go through, right, for FHA.
Yeah.
Now, with that said, you have insurance, depending on how much you put down. Could be for the life of the loan. But you also look at it and go, well, what is that county limit? That county limit is really tapped out.
Okay, what is the county limit?
Well, currently it's 362,250.
362,000.
If you look at the starting average price of a home, it's still hovering around 405, 406.
So what Dan is saying is that every type of loan that's out there, every county, no matter what county you live in, there's a limit. So like if you got financed in Hawaii and you were doing an FHA, that county limit could be at 800,000, 700,000. It just depends. So it looks like part of the problem is that we should probably raise that county limit because the median price point now for a home is at 405.
Well, the problem is this though, and it comes back to this market, it comes back to other markets. Yeah. If you think, okay, well, as a county limit, I'm going to raise it $50,000.
Yeah.
If that market appreciates, now it's accelerated.
Yeah, they can raise it again.
Well, let me explain. So let's say that the average price of a home right now, which we talked about, is 405, 406.
Yeah.
Everybody keeps moving here, overpaying over list. The market's on fire again next year. Maybe even we go to 15, not 18% year over year.
Yeah.
The average price of a home might be 475, 450, 475. So let's say they raise it to 400, 405. It still doesn't meet the demand.
Yeah.
That's the problem. The problem is they're constantly slightly behind on the demand here in Las Vegas.
So what they should do is be on top, right?
I would say so.
Yeah.
I would say, okay, let's look into factor. Now, do we see that this market's going to appreciate 15 to 18% next year? Maybe, right? It's got a good chance.
Because you can always make the adjustments. Now, the other thing is that the benefits with an FHA is 3.5% down payment.
Well, it's the down payment, but you can do 3% on a conventional loan.
Well, that's true, but I just want to focus on this FHA for a second here.
Yeah, I mean, the 3.5% is a benefit, and having insurance is something nobody wants, but you know what? Talked about it before. You know, you go to other countries, you go to other areas. The U.S. is very unique because the agenda is to push housing. It's to have a housing market that, you know, you have a high percentage of people buying homes. Without the insurance, there would be no 3.5% down payment.
So what he's saying is that when you actually make a mortgage payment, there's a PITI, right? It's abbreviated for principal, interest, taxes, and insurance. But when you obtain an FHA loan, you have mortgage insurance, correct? Okay. So that's another fee that's tacked on to that 3.5% down on the FHA, which makes your loan even more. Now, can you get rid of that insurance?
So if you put down 10%, you have.
I'm talking about at 3%, 3.5%.
Yeah, if you put down 10% of that on an FHA loan, I believe you can forgive it after 11 years.
Okay, what happens if you only put down 3.5%?
Then you're going to have it for the life of the loan.
Okay, so it was from my understanding years ago that after you have so much equity, you can automatically request it to come off. Is that correct?
Yeah, but that was changed.
So, see, that's good information because, again, I haven't done an FHA loan for some time, but when I bought my first home, I took advantage of that, right, with the FHA. And, you know, after we had so much equity, we were going to just take it out. But by then, we just decided to refinance.
One of the factors that's really good about FHA is the mortgage insurance. You're judged conventional loans, mortgage insurance, also interest rate.
Yeah.
Really directly impacted by what your credit score is.
You know what's weird is I had a call today in one of my listings. An agent contacted me and said, hey, I'm very interested in your home. We want to make an offer. I said, what kind of buyer you have? He's like, I have an FHA buyer. And home is like, it was like 500 or something like that, right? 500,000, but he wanted to submit an offer. And I asked him, hey, how much does your client have? They're like, hey, we're only approved to the county limits of that 362 whatever's, but they're going to come up with the rest of like 140,000. I said, if that's the case, why are they doing FHA? Why don't they just go conventional? It doesn't make any sense. He told me that according to the lender, the reason why, even with mortgage insurance premium, he's getting a rate like at 2.something%, and it's actually cheaper on the payment versus going conventional. And I was kind of like baffled. I was like,
let me say this.
Is that true?
Not necessarily. And I'm going to explain why.
That's kind of strange.
So
I've never heard of that.
Think about it like this. That to me doesn't add up.
Yeah, now, it doesn't.
Well, because if you have mortgage insurance, you got to think a payment on that's going to be about $250, $300, right?
Yeah.
So let's say the going rate for a conventional loan is 3.125, 3.25.
Yeah.
You bring it down to 2.85, let's say 2.875. You're probably saving maybe $50 to $75.
Yeah.
So why would you not want to have no mortgage insurance?
Yeah. So
see what I'm saying? Because the savings on the mortgage insurance, even if you got a lower rate, would exceed.
All right. So let's look at this. The home was purchased. Let's just say they're going to submit an offer at $500,000. The county limits is 362, right? 362. So what is that left? 362. So we're going to go 4, 9, so 8, 3. So he's putting down $138,000 to bring it down to the county limits to 362 for FHA. Now, if he put 20% down, right, on $500,000, basically he would be putting down $100,000. His balance would be $400,000. So,
well, think about it like this.
So then he wouldn't have the mortgage insurance. So now you would have to figure a loan off of $362,000 on an FHA with mortgage insurance premium. What interest rate would you get versus putting down $100,000, bringing the loan down to $400,000 on a conventional loan as a primary residence, depending on that rate? Then you figure out which is the better of the two. But does it really matter? And let me ask you this question, because he said this, because on an FHA, on a primary, is a lot lower versus a conventional as a primary. Which is lower? Or is it the same? Does it matter?
I think there's a lot of factors that comes into it.
I thought it was more like a financial situation. They couldn't go conventional. But I don't know.
Well, that's what I really feel is going on. So what I think is going on is that they're trying to approve for $500,000. The individual, whoever this is, had shaky credit.
Yeah.
They may have had blemishes, like maybe a past collection that's now paid off. And
that's what I'm thinking.
Because what will happen is this. I'll take it to an underwriter and I'll say, okay, look at this big picture of this file.
Yeah.
And they'll look at it and go, you know what? Looks good, but we're going to give it as a refer. And you're like, well, what's a refer? Right? A refer is manual underwrite. That means it's not going to go through the cookie cutter way of saying you're approved. Now it's going to come down to really you have stricter guidelines.
Yeah.
Some investors don't even do manual underwrites. Okay. So now it's like, hey, we're not going to. So now you're lowered on a lot of things. It's better to avoid that because now you're lowering your purchasing power.
You can go through the process and not even go through.
So to eliminate the added restrictions, right, and to eliminate all the problems that could come in, and they may even get denied. If you get a refer, the refer is saying that we don't really like the file. It's okay, but we don't really like it based upon this, and this. One of the things on a conventional loan is if you've had shaky credit, that's when you're going to get that. Yeah. And so when you have a problem like that, the next step is to go FHA. And my opinion is they probably try to run it that way.
That's what I'm thinking.
Shaky credit. Hey, let's do FHA. Payments cheaper. No, not necessarily. Because you got the mortgage insurance.
Yeah. But that's what I'm thinking. Exactly what you said. That was the first thing that came to my mind. But by running the numbers, I don't even think it matters if you were conventional or FHA as a primary. The rate should be pretty much the same, right?
No, it's not. Because
it's not.
No.
Oh, I'm wrong.
So when you do an FHA loan, for the most part,
yeah,
it's not judging you as hard.
Okay.
As far as across the board.
So I would literally get a lower rate then.
Potentially, you'd get a lower rate. Now, if you're on a conventional loan, and depending on your down payment, depending on your LTV, your reserves, things like that, you may get same if not lower rate.
But now I want you to think about this. This gentleman's going FHA, right? Putting down $138,000, which is he's having a lower payment. But if he went conventional, put down $100,000, he's still left over with $38,000. But we know that FHA, their interest rate may be slightly lower. You could take the $38,000, buy down, right? No? Correct me.
You have a 3% rule.
What's the 3% rule?
So there's the ability to repay. You have a 3% rule, which is you don't want to go into a high-cost loan. And what people don't understand is you can't just say, well, I got $10,000. I'm going to throw everything at it in the kitchen sink to get this rate down to 2%.
Yeah.
You can't exceed all of your costs including your discount or your buy down, it cannot exceed more than 3%, or it's now a high cost loan.
I don't understand. Explain it to me in detail.
So look, if let's say your closing costs, down payment, everything costs 2%.
Yeah.
Right? And we're talking escrow fees, title fees, everything. That means you got 1% to play with.
Ooh.
So now you got 1 point to buy down the rate. That might only buy you down a quarter of a point.
Wow, I thought you could always buy down as much as you want.
Nope.
So whatever it is. So look, what you're saying is if your total closing cost is 3% of like say 200,000, that's $6,000. Okay. You absorb 2%. So now you're only left with $2,000 because that's 1%. Is that what you're saying?
That's right.
So now you can only buy down $2,000 worth.
Yeah, because the regulations that were put in place was, again, I don't agree with it. I think you could.
This has got to be new because
No. It's been around. But
like,
the thing is,
for conventional or FHA?
Both.
Really?
Yeah. See, look, the thing is this. You can't look at a situation and go, well, buying the rate down is not the benefit to you. If you got money and you want to buy the rate down, buy the rate down.
Yeah.
Right? Put $20,000 into it. See, the reason why these jumbo deals get along is because think about 1% of a $2 million deal.
Yeah.
It's $20,000, right?
So you can definitely buy down.
That's 1%, I believe. So, yeah, I mean, you can definitely buy it down. You got a lot of wiggle room, right? And that's where it depends on your loan size because it comes off of your loan. So if your loan's $400,000, $600,000, $800,000, got a little bit more wiggle room. Because you got that 1 point or that 2 point or that 3 point is now a lot higher, let's say, than you're buying a home at $300,000 or $250,000. Like if you got an investment property out there and you're at $250,000, you really don't have a lot of room to buy the rate down because it's a low loan amount.
Okay. Now, also, you have to watch out if you're able to buy down, depending on the market, and correct me if I'm wrong, how much can you actually buy down, right? Because the market shifts all the time.
Well, it does.
What I mean by that is you may spend that $2,000, but you may not get a quarter of a point. You may only get an eighth of a point. Versus,
it really depends on. Yeah, you're 100% right. It depends on the markets. It depends on how the market's trading.
Yeah.
Depends on investors. Depends on geopolitical news. I mean, there's a lot of factors. But yes, you're absolutely correct. If you go in and you price something out, say on Monday, costs you half a point. Yeah. Right. When I say half a point, so $1,000 could cost you $2,000, $3,000 because. Now what you're looking at on, let's say, like as you go down the road, that pricing may have switched, and now that discount cost is a lot higher.
You know what? This is a lot of great information, and I wish that we had time. Unfortunately, we do not have any more time left, but I want to actually continue this on next week, Wednesday at 5 p.m. Pacific Standard Time, because when it comes to financing, there's so many programs out there. There's just so much things that you need to know when it comes to financing. There's so much tips and tricks. So stay tuned till next week. We're going to bring Dan back on as a co-host because that's what he does. And you guys know that he's a lender. So if you guys are thinking about purchasing a home, visit lvhomeexperts.com. Click on the financing button. That will bring you over to Dan's website. So that way you can start the financing process. Other than that, thank you so much for tuning in. I'm Chakits. Until next time.